Hi believers, this is Amit from Waya team and I'm here to provide a weekly bite and the road ahead in the markets. I will go a little slow as today's note is an important one to listen. The Nifty ended 2.5% down while the Bank Nifty was down by 2.6%. In overall picture, the Nifty index has dropped more than 10% from its September high and is currently nearing the lowest point in the last 5 months. It's trading near to 200-day exponential moving average, which is considered as key support level. Looking at specific levels, Nifty has support of 23,300 and 23,000, while resistance lays around 23,800 and 24,000. The Nifty mid-cap and small-cap indices have experienced even steeper declines, falling over 10% from their recent peaks and officially entering correction territory. The Nifty Midcap 100 has dropped 4.1% in the past week and 11% from its September high, while the Nifty Small Cap 100 has fallen 5% over the past week and 10% from its September peak. This fall in mid-cap and small-cap indices suggest that the current market downturn might continue in a near term. Several factors are contributing to the cautious market sentiments. Number one, underwhelming Q2 earnings. Revenue growth has been muted and both profits and margins have declined. While the banking, financial services and insurance sector has outperformed, non-financial companies are struggling. Number two, slowdown in high-frequency economic indicators. While the sources do not specify these indicators, they point to a broader economic slowdown beyond corporate earnings. Number three, retail inflation has surged to a 14-month high of 6.21% year-on-year in October, exceeding the RBI's upper tolerance limit. This high inflation is dampening hopes of an RBI rate cuts in FY25. Number four, despite the recent market declines, valuation remains high, making investors hesitant. The ongoing correction is nothing but removing the excess froth in valuation. Going ahead, the focus will be to look at the companies which is benefiting from the domestic demand as the global scenarios are volatile. Specific sectors that are experiencing a slowdown in demand are FMCG, retail, auto, and mall operators, as well as chemicals, consumer durables, and building materials. There is also stress in the unsecured loan companies, select private sector banks, and NBFCs, which is keeping Bank Nifty in pressure. Street is now focusing on earning growth in Q3 as a key factor in restoring markets' confidence, but that looks far right now, which means market can show consolidation in near future before resuming the uptrend. Now let's talk about the sectors with strong performance. Among large cap stocks, public sector banks performed well due to lower credit cost. Steel and mining sectors benefited from favorable raw material prices. In small cap, green energy based stocks, recycling, real estate and data center based stocks did very well. Over 70% of these companies in these sectors beat earnings expectation. The internet-based new age stocks and pharmaceutical sector also saw over 70% of the companies outperform the estimates. On macro level, the recent surge in inflation to a 14-month high is largely due to food inflation that is expected to ease in coming quarter. RBI is unlikely to start its rate cutting cycle in such high inflationary environment that could have acted as a relief to the falling stock prices. One good development that has happened last week was CLSA and Moody expressed an upgraded outlook on Indian equities. CLSA has raised India to an overweight position, increasing its portfolio allocation to 20% above the MSCI benchmark, while Moody also took a favorable stance, citing structural economic improvements and capital expenditure supported by government policies. These positive reviews reflect growing confidence in India's ability to sustain its economic momentum. However, higher US interest rates and sharp rise in US dollar in short term is the reason global investors are selling emerging equities. Current global factors are expected to impact FI inflows. Hence, we expect market to remain sideways to negative in coming weeks. Sectoral rotation and Trump's policy-driven news from US would influence sentiment, particularly in interest rate sensitive sectors like banking. Key takeaways from today's bite are: earning needs to improve for many companies to justify valuation. Remember, the stock price is a slave of earning. Sooner or later, market needs earning to drive prices. Focus on stocks with good earnings and domestic facing industry in near term till we have global visibility. That's all for tonight. Thank you.